So main mortgage lenders, so the likes of Halifax, NatWest, Nationwide, do not like you remortgaging or borrowing funds against your property for purpose of a business investment. And the reason being is there's too much underwriting involved, and they think that if we raise 100 grand on your property to put into a business, that business fails, can you repay your mortgage? And the way they look at it, are we going to have to repossess your property? If there's any risk, they don't enter into it. So the lenders that we look at for these sort of items are the small private banks and the building societies, where they underwrite it how I used to when I first started in this industry 20 years ago. So if you have a mortgage at the moment, there are lenders that would allow you to take a second charge against your main mortgage and leave that alone. So if you were lucky enough to get a 5-year fixed rate last year, 2 years ago, and you're paying 1-2%, we do not want to touch that mortgage whatsoever to raise funds. What we can do is, alongside your main mortgage, raise what's called a second charge or a puny mortgage for business purpose. The lender is aware of it. They will look into it. If it makes sense, they will release the funds direct to you to use for the business. So for investing in a business or growing your current business. So as I put in the notes, raise funds alongside your existing mortgage. We'll leave that alone. And some, should really say most, lenders do not like business use for funds. The other way of doing it is equity release. So if we have any relatives that are sat on a property worth a lot of money, they want to help you, but they are asset rich, cash poor, they can take out what's called equity release. Now, it's not the dirty word that it was several years ago. It is heavily regulated now, and family members are encouraged to be involved. And what that does, say parents own a property worth £500,000, we raise 100,000 against that. The interest can either roll up, so no monthly payments are made. We can service the interest itself, so the interest that the loan does not roll up, or we can overpay it at will. That is one way to do it. The other way is to pick a lender that will allow you to be able to raise funds against that property on the main mortgage itself. So if you're on a standard variable rate and you need to look at a new deal, we can approach a lender that would allow you to borrow the additional funds for a business use and take the main mortgage with it. Now, it's absolutely not a one size fits all with this. We could have some relatives that are willing to help. We might not. We might be sat on a property or some security that we can raise finance against. Now, the sort of benefits of this is, if we bring investors on board, they're going to want to cut that business going forward. And hearing some of the horror stories in the Start to Stand Up group of investors taking more, disappearing, taking over the business, forcing out the founder, we can avoid that. And the interest rates that the banks are going to charge on these kind of finance options are not going to be like giving away 20, 40, 50% of your business in the future to investors that just stumped up the original capital. So we can like bypass the middleman as such and have more control over our own business. Is there any questions on any of those points at all? No. So yeah, put in there the benefits. We invoice investors, paying a percentage of the business to them. So that is one side of the business. We are the traditional mortgage brokers, as mentioned. The other aspect is often overlooked, and that is protecting the most important aspect of this business, which is the people that run it. We look at the vehicles, the property, the equipment. What we don't consider is the actual people on the tools themselves, and they are us and our key employees. So we look at 3 main areas of this, and the way I was taught it is SLK: shareholder protection, loan protection, key person. Now, With a shareholder protection, if we've got 4 directors, equal shareholders, and one of those directors dies, what happens to those shares? Could this bring down the collapse of the business? The family aren't going to be able to do anything with a 25% share of the business, and the business has lost a very important member of staff. What shareholder does is that kicks in, pays out an amount so the business can buy those shares from the family. The business continues. Moving on to L, loan protection. So if we have taken out some finance to fund the business, grow it, invest, etc., and again a key person dies, what we're going to do with that loan? Is that going to bring about the end of the business? Final one, K, key person, is we can ensure the profits that that person brings to the business in case of their loss. So if they were bringing in £1 million a year, we could cover against that. And the payout into the business can be used for specialist recruitment, so they can bring a person on board, paying the bills in the meantime, salaries, etc., and keeping the lights on the business, which is very important. Something that's becoming more popular, and we're hearing it on the radio, seeing it on the TV, etc., and was talking about it with Ollie and Lee just before, is private medical insurance. Is the businesses we work with are going 2 ways. Is it's disappearing into the old boys club, but then the businesses that are saying, let's look after our staff, they are our most important asset. If anybody's tried to ring the GP of recent over the last couple of years, you're lucky to get on the phone, let alone an appointment the same day, and you're going to ring in the next day and so forth and not get an appointment. We're not going to get seen. This problem is going to grow. Private medical insurance can step in. It can get the person seen quick, and the problem cascaded. So if they need to see a GP, you pick up the phone, get a video call. They will either take you to the pharmacy, to the hospital, or to an osteopath, physiotherapist, etc. Now, it has a wide range of benefits. This does is the person who has the cover is less likely to leave. So the person we put all our time and effort into training them, they are going to stay in that business. We can cover their spouses and children. If they do go off work sick, we're going to get them seen quicker and get them back to work quicker. And also with any outpatients and the treatment mentioned before, like osteo and acupuncture. Certain insurers offer deals and discounts. The big ones are for dentists, opticians and audiologists. Now, I looked at a quote for a client this last week, and what he was spending on him and his family for glasses is that this covered it. And on top of that, they've got the private hospital care, they've got cancer care, outpatient care, online GP, etc. So it works well both with the personal side of things and from the business. Now, with how recruitment's gone, it's very much an employee's market out there. There's a shortage of good people. Now, it's about attracting the right talent with these benefits, but then more importantly, keeping them. If we lose a member of staff, then they take our secrets with them in a way, and we don't want that to happen, even some clients. So again, that can work both for the personal and the business side of things. Now, kind of tying in nicely with the raising additional funds is traditional banks do not like complex income mortgages. And the reason being, when we submit an application now to Halifax, it's underwritten by their online system. It will do an automated valuation on their property or the one they want to buy. It will check their bank, regardless of who they bank with, and it will go, yeah, just send us the latest payslip, all good. If somebody's self-employed, that changes massively. is there's a lot of time taken to underwrite a self-employed case. They need 2, maybe 3 years books, projections. In the time it's taken Halifax to do a deal like that, they could have done 100 employed mortgages. So they don't like them. The smaller banks and building societies that look at business use finance that we touched on before look at and like complex income. Now, if you're employed, they look at your salary. Some banks will look at your salary and dividends if you are a director. But quite often we do not take all of the money out of the business as a dividend. If we do so, we pay corporation tax. We might just take a basic salary from it. Now, the accountant's doing their job, keeping the tax down, but from a bank's perspective, if we're putting through 12 grand a year as a salary, we're not going to be able to borrow anything, even in Buxton, where I reside. Some of the lenders that we work with will use retained net profit and salary. So if we keep that money in the business year on year, and that money grows, and we pay ourselves a salary, lenders will look at that and underwrite it properly to say, is it sustainable? Is it affordable? Very much with mortgage lending and with insurance, with the panel that we use, it's all about knowing where to put a particular inquiry. Again, not one size fits all ever. We've got access to pretty much every lender in the UK, same with the insurers. It's knowing, listening to the person, what's going on, what do we want to achieve, what does our income look like, this is the bank building society that we can look to place that with. So that is how we can help out with complex income. Recently took on a new starter, brand new to industry in 3 months, and he's not had one straightforward case whatsoever. It's been retained net profit, complex income, holiday lets, that kind of thing. But very much we train hard. So they are the slides on that. So they're my contact details. Got the Buxton landline if anybody does want to call that. If you do have any questions whatsoever about the finance thing for investors, protecting us or our members of staff and family, or anything whatsoever, then please do get in touch.
Thanks, Matt. We'll take the screen down and we can have a Q&A. Any questions for Matt on the stuff he's covered this morning?
Yeah. Matt, good presentation. Thank you very much. Admittedly, I would like to understand more about the second charge, right?
Yeah.
I take that's the maybe easiest option among the ones that you have highlighted. Can you give me a bit more details on how the process would work, how long it is usually lasting for? Anything that can help contextualize a little bit more the product itself. Thanks.
So, for example, if you had a property worth £500,000, we've got a mortgage of £100,000 on a good 5-year fixed rate, is we can approach a different lender who will take a second priority behind the main mortgage lender. We can run it as long as the mortgage term, if not longer, and we can overpay it. Now, because it is a second charge, they have second priority. Now, the way a bank works is they work from a worst case scenario upwards. So they assume every applicant is going to default on their mortgage and it needs repossession. So the main mortgage lender gets first dibs, and then a second mortgage lender, a second charge, they get second dibs. First up, best dressed. The rates are higher.
I was going to ask you that, yes.
They're not 15, 20%, anything like that. They're kind of hovering probably about 7, 8% at the minute. If we look at that in the grand scheme, if you're investing in the business and giving away 20, 40%, etc., what is that worth over 10, 20 years? And we can keep those professional investors out and keep more control of the business.